Thank you for joining NAA's micro webinar series. My name is Stephanie Anderson, and I am the Industry Operations Manager here at the National Apartment Association. If you are new to our series, thank you so much for joining us. If you have been with us on this journey, we do welcome you back and thank you for your continued support. In an effort to provide our membership with timely operational guidance amid COVID-19, we are producing updates in the form of micro webinars. Each week, we will focus on a different topic relevant to the apartment industry. At this time, I would like to direct your attention to the screen. Please take a moment to review our disclaimer. Today, I am excited to welcome Patrick and Julie from Yardi Systems. Patrick and Julie will be sharing expert knowledge on resident screening and the impactful changes amid COVID-19. Welcome, and thank you both for being here today.
Thanks, Stephanie. Excited to be here. Hi, everyone. I'm Patrick Hennessy, and with me today is Julie Domain from Yardi's Boston office in Waltham, Massachusetts. We're here today to talk about resident screening in the COVID era. 2020 started off with a bang, and things got out of the gates very quick in terms of screening volumes and applicant quality, sort of a continuation of 2019. So we were in a very strong position coming into the end of February and into early March. And then around March 14th, the US went into lockdown and things began to slow down. So here today, we're going to talk about some trends that we've seen in our data during the COVID time period, and then talk about some feedback that we're getting from our clients in terms of what they're doing for criteria, how they're evaluating income and employment in this challenging time, and what they're doing as fraud continues to sort of populate across the industry. So first and foremost, let's jump into some data. And so what we're looking at on this chart is the percentage change in traffic volumes at apartment communities in the US on a weekly basis compared to the historic average for that week. And so we can see the week ending on March 1st and the week ending on March 8th, things were pretty flat compared to the historic average for those 7-day periods. And then we get into the week of March 15th and we start to see the drop off, all the way down to the end of March and the first half of April, where we saw approximately a 40% drop in application volumes at a national levels. Some markets saw a drop as high as 60%. Other markets barely saw a drop at all. But in aggregate across the US, application volumes for a 3-week period were down about 40%. And then things gradually got better from there, trickling up to about even by mid-May. And then the last 6 weeks in most markets have been just crazy. Application volumes are well above the historic average for that time period and pushing almost 10% at times above the expected application volume in a given week. And so while we had 6 or 7 rough weeks there, it looks like things have stabilized. And if we look optimistically to the future, hopefully this is behind us and we can kind of move on. On the other side of screening, in addition to looking at the number of applicants coming in the door, is the quality of those applicants. And so on the screen now, we're looking at the creditworthiness of the applicant pool across the United States. And so the blue bars represent the median credit scores of the applicants in 2019 on a week-by-week basis, and the orange bars represent the median credit scores in 2020. And so typically, in addition to seeing more applicants in the summer months in most markets, we also see the highest credit scores in the summer months. Generally, people who are in a position to kind of dictate when they get to move prefer to move between the school years and in the better weather. And so we generally see an uptick, as you can see in the 2019 blue bars, as we get into May, and then things sort of stabilizing into June. We're seeing a bit of a delay in 2020, as a lot of the people who were out sort of in the depths of COVID were people with less than ideal credit. And so for that month-long period between mid-March and mid-April, not only did we see far fewer applicants coming out looking for apartments, the creditworthiness of those folks was also below what the historical average would be for that time of year. The good news is, in recent weeks, we've seen both the application volumes and the creditworthiness of applicants coming in the door improve significantly. And so hopefully if we see a few more strong weeks or another strong month or so, will essentially be able to negate any of the gap that was created by the 4 to 6 weeks that were very challenging during the depths of COVID. Just a few other noteworthy data points that we're observing, and based on our aggregate data, we're seeing fewer applications submitted around the weekends. And so I think people are less likely to be out when things are at their busiest on Saturdays and Sundays. So overall application volumes from Saturday to Monday are down about 6% or so compared to the historical averages for those days. And then we're seeing an increase in volume Tuesdays through Fridays. So more people are applying online after maybe they go out and tour the property and then go home, decide to apply from the comfort of their couch at 10 p.m. on a Tuesday, Wednesday, or Thursday night. And so again, less weekend activity, more midweek activity. We've seen a 30% increase in online applications between February and June, going from about 20% in the wintertime up to pushing 30% currently. And so more and more people going through the online leasing process as opposed to going through the traditional method of filling out a paper application. Interestingly, we haven't seen a material change in applicant incomes. So most people coming in the door and applying are still employed and are still making income similar to what we had seen up till this point in most markets. We're seeing reduced application volumes in many urban markets. So New York was down almost 70% at the toughest times during COVID. Boston, DC, Seattle, San Francisco were down 40 to 50% compared to what we would expect to see for application volumes back in late March and into April. But on the flip side, we're seeing a spike in application volumes in suburban and tertiary markets. There seems to be a trend going where people are moving out of the cities and out to suburban rental properties. So we have a combination of the people who would have been in the market in March and April, plus the people who would regularly be in the market right now at the peak of leasing season, plus the people looking to leave the city and get out to those suburban markets, is causing a significant spike in a lot of those areas across the country. So that's most of what we wanted to cover today on the data front. But now I'd like to pull in Julie Domain, who works with me here in Boston, talk a little bit about what we're hearing from our clients from some of the largest property operators across the country. So Julie, do you just kind of want to walk through what we're going to discuss today?
Absolutely. Thanks, Patrick. We're seeing really 4 main points here that are the priorities for the property operators. Criteria adjustments to go along with the current market conditions, verifying employment, evaluating unemployment benefits as income, and then the hot topic on everybody's mind, fraud, and how to do your best to prevent fraud.
Excellent. So it's exciting for screening to be so relevant again. I think things were so good in most markets across the US for the last 6 or 7 years that a lot of property operators weren't paying too much attention to their screening practices and their screening criteria. And so I think COVID's kind of brought that back front and center. So it's exciting to see people paying quite a bit more attention to what they're doing on the screening front. And so let's talk a little bit about screening criteria adjustments. I know, obviously things will vary on a market by market basis, but what are some of the things you're hearing recently from some of your biggest clients?
Sure. The number one thing that we're hearing is that renewal rates are a lot higher than they used to be. So because of that, property operators are trying to determine if a change should be made at this time. Obviously, with increased renewals, occupancy remains fairly consistent. We've had a lot of conversations with companies around what others are doing. It seems like a lot of property operators are taking a wait and see approach and just in a holding pattern to determine if they will need to make changes. But for the companies that have made changes, we haven't seen anything drastic. Most of the tweaks have been minor, some of them around the credit thresholds. And we've seen these changes on both sides. So we've seen companies tighten their criteria and also loosen their criteria. So in a market like Atlanta, where the processing is booming, those property operators are looking at their criteria and looking to tighten up so that they can really get the best of the best in the door. Whereas the harder hit markets like New York and Boston and Seattle, they're looking to loosen up the credit requirements so that they can get more folks in the door. Also, the criteria changes that we've seen have been around income requirements. A lot of companies are looking to soften the income requirements. Not a ton, but say they normally look for 3 times the rent. maybe they're looking now for 2.5 or 2.75 times the rent. And also, instead of straight out rejecting someone who isn't meeting your income requirements, a lot of property operators are thinking about looking for an additional deposit or possibly a guarantor to soften up these requirements.
Interesting. So it sounds like there's a lot going on right now. So, you know, obviously a lot of people are focused on how to get through these few months, but you know, we want to take some time to think about the future. And what are you hearing about future concerns for screening?
Sure. The biggest concern is COVID-related hardship. We on this side, we're really viewing this as a future concern because those people that would be out there that are most impacted are not applying to the large property management companies right now. So the biggest concern is really around the impact of the CARES Act, which allows consumers to request certain items on their credit file to be suppressed. One of the major credit bureaus recently came out and said that they have had requests for over 100 million trade lines to be suppressed from applicants' credit profiles. So it'll be really interesting to see how this impacts the screening a little bit in the future, maybe next year once we're through this COVID.
Yeah, less data is going to make it a little more difficult to evaluate people. So that's very interesting. So let's move on to income and employment. You know, most people have seen the news. You know, 40 million people lost their jobs during this COVID time. And so what are property operators doing to ensure that they're renting to people who are going to be able to pay their rent?
Absolutely. So number one, the biggest concern is how to know if these applicants are employed. So right here, it says, are pay stubs still reliable and of value? I could lose my job today and go in and apply to an apartment with my pay stub from last week, and it looks like it's up to date. And you know, the property operator might think I'm still working, but I know that I'm not working. So one thing that's of concern is to make sure that, you know, these applicants are still employed and are going to be able to pay their rent. So to help look at this, there are several alternative tools out there that are available in the screening market. One of the big ones is access to payroll databases. So there are databases out there where instantaneously you can find out exactly how much someone is making, how often they're making this money, and what their current employment status is. So that's a big one there. And then looking forward in the future a little bit, maybe, you know, 3 to 5 years, we'll be looking more at applicant permissioned access to bank accounts. So essentially open banking, where applicants will grant the property operators access right into their bank account to be able to see their cash flow and their spending habits. Right now, you know, with the way that the rental market is, there's not that much of a need for this, but we really think that this will be the wave of the future.
That's great. It's nice to see the onus taken off the resident to print out pay stubs and upload them, and you know, kind of reducing that friction. And at the same time, making sure people aren't submitting doctored pay stubs, which is great as well.
Absolutely.
So let's talk a little bit about those. That's great. So Julie, those folks who have lost their jobs and who are collecting unemployment, who are out there looking to rent a new apartment, how are the large operators managing that?
Sure. So, you know, as you all may know, in many states and cities, you can't discriminate against source of income. So there needs to be a way to evaluate unemployment benefits as income. So what many operators are doing is they are establishing a formula very similar to what they would use for evaluating pensions or Social Security payments as form of income and applying that to unemployment benefits. You know, like anything in the rental market, the FHA dictates everything. So consistency is key. So these operators are really looking to establish a consistent process using all of these pieces to figure out the best way to evaluate these as income.
Excellent. So let's get to the hot topic of the day. Tell me what you're hearing about application fraud.
Sure. Yeah, this is definitely the hot topic here. So one thing we're hearing is that there is an increase in fraud being noticed by property operators. Part of this could be that a lot of places have come to a standstill, so in-person tours aren't happening and everything is really moving more towards online. So there's a couple of different types of fraud that's being noticed. Number one is the straight identity theft. So someone coming in applying as someone else. And then number two is synthetic fraud, where essentially someone is applying as a made up person using different pieces of information, maybe from other people. So obviously the biggest area of exposure here is the online leasing, because people are sitting behind a computer and just putting the information in. So to help mitigate against this, there are many new tools that have become available. So one of them is government ID validation. So this is the ability to determine if an ID is real. So you would go ahead and apply online, and then your ID would be uploaded and it would be determined if it is a valid, real government ID or not. And then the second piece of this would be the biometric piece. So for that, after validating that the ID is in fact real, you would be uploading a selfie as an applicant, and it would be matched to your picture on your ID to make sure that you are in fact who you say you are. Which again, when there are in-person tours, it's a lot easier to take a look at someone's picture and look at their face and see that it's them. And with that online component, it's really hard to do that. So that's one piece of information. Another tool that is available is the knowledge-based authentication, or the KBA. A lot of you people are probably familiar with this already, but essentially this is a series of questions, maybe when you're logging onto your bank account, which helps validate that you are who you say you are based off of your credit profile. So you would log in and you would get a question like, what street did you grow up on? Or what was your car payment for your Honda Accord in 1997? And you'd have a certain amount of time to answer that question and answer it correctly. And from there, it would authenticate that that is your credit profile. Obviously, property operators really need to take a look at their resident profile to determine which one of these would be best for them. If you have a lot of younger folks coming in and applying for apartments, they might not have had the time to build the credit profile, so the KBA would not really be useful, whereas using the government ID validation would work a lot better in these instances.
That's great. Sounds like there's so much going on. And so just sort of looking ahead and coming away from everything that we've discussed in the last few minutes here, some of the key takeaways are just incorporating identity and income verification into the online leasing process. And as Julie mentioned, without people coming into the leasing office and handing over IDs and handing over documents, being able to collect and validate all of that information in real time online and not making things too difficult for the prospective resident is going to be critically important. We're still in a period of economic uncertainty. And so unfortunately, no one has a crystal ball to be able to look at and say, is the worst behind us, or are we kind of at rock bottom, or have we still not seen the bottom yet? And so I think, as Julie mentioned, a lot of folks are still sort of in a holding pattern to figure out what does the future hold. In terms of people coming in and applying who are on the unemployment benefits, the $600 federal supplement that's being paid out weekly expires on July 31st. And so without an extension to that program, or without the approximately 30 million people who are getting $600 a week as part of that program getting back to work, it could be challenging for people to be able to pay their rent in the second half of the year. And there could be fewer people coming out and looking to apply if they don't have that steady stream of income coming in. In addition, we're with the borders more or less locked down as a result of COVID, we're seeing reduced immigration, and we'll likely see fewer foreign students coming in the fall this year for our universities and colleges across the country. And so this could have an impact on the number of applicants that you have coming in the door, as well as how you screen your applicants. And then, as we touched on a little bit earlier, the urban markets seem to be hit a little bit harder, and we're more locked down as a result of COVID. And looking ahead, we're starting to see people sort of move out of those urban markets. And so the recovery curve for those urban markets may be quite a bit longer than what we're going to see in some of the secondary and tertiary markets. And so that's everything we had for you today. And with that, I'd like to turn it back over to Stephanie.
Patrick and Julie, thank you so much for your time today. You have provided a wealth of knowledge in so many different areas, and I am curious to see where these trends will go in the weeks and months to come. So thank you again for sharing that. For everyone who joined us today, we do thank you. Should you have any questions, concerns, or comments on anything related to COVID-19, we do encourage you to email cv19questions@naahq.org. It's on your screen now. And please feel free to email us, let us know what you need assistance on, and we're here to help and support you along the way. Again, thank you so much to our great speakers today, and of course, Yardi Systems. And we look forward to seeing all of you back again next week for another great micro webinar.